We're turning to the innovative models making home ownership attainable. So the dream of home ownership seems out of reach for many. I think Linda even mentioned it maybe on Tuesday night when she was pitching that the average home age was, I think, 37, which is a huge increase from what it was 10 years ago. So I'm delighted to introduce our new panel who are changing their company, are changing the way that we kind of see home ownership and making it achievable for younger people. So I'm going to introduce Jennifer Harrison, who is the Director of Startups and Scale-Ups at Reputation Edge. So in the meantime, a huge round of applause to our panellists.
Thank you, Lucinda. Good afternoon, everyone. Now, there is no topic hotter at the moment than home ownership and housing affordability. We all know there's a problem. It's even #housing crisis. Barely a day goes past without the national media reminding us of this housing crisis, and there are various versions of it. One version is the young professional couple, the university-educated couple, who are struggling to save a deposit. Just to put some numbers around that, in Sydney, the average house price in Sydney is $1.2 million. That is the average house price. To buy that house, you will have to add another $50,000 of stamp duty and costs. So you're looking at $1.25 million to buy the average house. Now, the maths on that works out very nicely because you need 20% to avoid lender's mortgage insurance, which is $250,000 you need. Then you have to borrow the million. Now, in today's market, at 6% interest rates, a 30-year principal and interest loan, you will be paying $7,000 a month, and under responsible lending, you will need at least $240,000 of pre-tax income to get approved for that loan. At the other end, we have older people who have equity in their property, but they can't tap that equity very easily unless they sell, which is an option. It's difficult for older people to borrow, and often they don't want to borrow. They don't want to still be servicing a mortgage at a certain time in life. We know the Bank of Mum and Dad is a top 10 lender in Australia, but how sophisticated is the Bank of Mum and Dad, and are they helping their kidults onto the property ladder to the detriment of their own comfortable retirement? And what's being the Bank of Mum and Dad doing to their retirement savings and income? So, these are just some of the issues, and this is a fintech issue because essentially we're talking about the debt and the equity that helps us own the asset, being the property. So I'm delighted to have these amazing people here who are innovating around the debt and the equity and how we own homes. So quickly to say hello to everyone, I'll start at the other end. We have Jess Ellen from Hope Housing.
Hello, thank you.
We have Imogen Baxter from Own Home.
Hello, thank you.
Michael Raghavan from Our Leg Up.
Pleasure.
And a lady who probably needs no introduction to this audience, Linda Coker from Cooperative.
Hi, thanks for having us.
Perfect. Now, my first question to each of the panel is, really quickly, what is your elevator pitch? What is the problem you solve, and how do you solve it? Jess.
Thank you. So Jess, I head up investor relations at Hope Housing. So my role is to fundraise for our fund. We are a fund manager, and what we do is co-invest with essential workers, so teachers, nurses, police, fireys, to help them buy a property closer to where they work. And so many of you will be aware not only of the housing crisis, but of the real challenge that middle income workers who are essential workers have in actually living close to their place of employment. And it's causing huge retention issues, productivity issues. And as a community, every one of us in this room suffers as a result. So we're here as a fund manager to make a co-investment alongside their deposit and mortgage to actually get them into a buying range that gets them within 30 minutes commute of that place of work. And we do that through partnering with a mutual bank called Police Bank, and they've been with us since day one, and they've been incredibly instrumental in helping us bring this to life. And I'm sure we're going to talk a little bit about some of the challenges that we had to overcome together in that partnership. partnership to bring the product to life. But we have been in market now for 2 years, and we've made co-investments into nearly 20 properties, which is really exciting. We're about to close our first fund, which has really been our proof of concept in market, and then open our second fund. But that's on the homeowner side. There's a elevator pitch for investors as well. Obviously, homeowners get it pretty quickly. You know, everyone would love someone to come in and give them a little bit more buying power. But on the investor side, the investors that come into our fund get equity exposure to the Australian residential property market, which is an $11 trillion market, and actually really, really hard to access at scale if you're an individual investor. So you can come into our fund, you get diversified exposure in a unitised way to great assets that we vet, with great homeowners that cover all of the costs of maintaining those properties. So you as a unit holder aren't wearing those typical landlord costs. And then you get a return which is roughly 1.9 times the market. So you're getting a great return, and you're getting obviously the social impact that comes with that as well.
Fantastic. Thanks, Jess. Imogen, tell us quickly about Own Home.
I would love to. I also had Invisalign yesterday, so if it sounds like I'm taking the piss, it is exclusively out of myself. So Own Home is a new consumer lender. We offer borrowers a low deposit pathway to home ownership. And how we do that is that we provide a loan for the 20% deposit, and you can pair that with an 80% LVR loan from another lender. So let's say that you're buying $1 million property around the corner in Melbourne. You can get a $200,000 loan from Own Home, and you can pair that with an $800,000 loan from, let's say, another lender like ING, or you can get it from us. Along with our deposit loan, which is kind of extremely boring in its nature and that is just a really vanilla second mortgage, we have an incredible 5-star rated home buying service. So I don't know, put your hand up if you're a homeowner in this room. Oh, a few. Put your hand up, keep your hand up if you enjoyed that experience of buying your first home. Yeah, it is truly one of the worst customer experiences buying a home, and because we know first home buyers are particularly susceptible to all of the traps you fall into when you buy a property, overpaying, buying a lemon, not checking the building and pest inspection report. We have a free service that does that on behalf of our clients, and the benefit of that for them is really that they're able to buy a property that will accrue in value really quickly, and because we're an on-ramp to home ownership, what that means for them is that they're able to refinance us out really, really quickly. We launched last year in September, October. We've had 50,000 applicants through the door already, and we've been really lucky to have investment from Melbourne's best, well, Australia's best venture fund, Square Peg Capital, which is Melbourne's very own, as well as investment from the venture arms of NAB and CBA. And so really we exist because we believe homeownership is becoming hereditary, and we want to ensure that more people have access to building a life in the safety and security of their own home.
Wonderful. Thank you, Imogen. Michael, tell us about our leg up.
Sure. So our leg up. Well, in Australia, not owning a home is the #1 driver of generational wealth inequality. For most Australians, homes are their largest asset, most important wealth accumulation vehicle. But saving a deposit is the biggest barrier. So we're building Australia's bank and mum and dad so that lenders that partner with us can democratise access to home ownership. What that means is that for an aspiring homeowner, they can get a property with as little as a 5% deposit, at the same interest rate as a 20% deposit, and they save on lenders' mortgage insurance. So they're getting in years faster, saving tens of thousands in the process, and we make that possible by taking the concept of a guarantor home loan and evolving it into a diversified investment product. So for the established homeowners, for the investors, they're now able to generate a return on inaccessible equity without any capital outlay, and that's a new financial instrument we've created.
Love it. And Linda, tell us about Coopity.
Great, thank you. So Linda, co-founder of Coopity, co-founder with Liz Roche, who I couldn't have done it without. So we're trying to deliver on housing affordability by making it easy for people to co-own property with a friend or family member. We're also targeting parents who want to help their kids buy, because we feel that actually co-borrowing on title is better than gifting the money in many scenarios. It shouldn't be at the expense of their retirement. It also delivers asset protection, because often kids partner up and that relationship doesn't work out. And it's better than a loan, because banks will see that loan as a debt of the child, hindering affordability. And also the kids borrow less, so it brings forward transactions. So it's sort of a win-win-win for the parent-child lender. But literally we are trying to help people co-own. We feel there's a lot of natural scenarios where co-ownership exists anyway. Deceased estates with multiple children inheriting a property, granny flats, later in life co-buying. And essentially what we do is we platform the co-purchase transaction from authenticating co-owners, the property evaluation, plugging in the conveyancer and surfacing a co-ownership agreement for execution, really at a democratised cost. We are direct, but ultimately we see ourselves as a platform, as a service to business. We go to market predominantly via brokers. We have a non-bank lender who is fully integrating our solution, and our agreement will be part of the security packet and enforceable by the lender. But we are open to partnering with accountants and property firms, etc. But as I said, we only launched in April, so we're early. We're bootstrapped, and I'm really, really happy in terms of we have our platform up and we're in market.
Wonderful. Okay, we're only just getting started. Okay, so the second question is to lift the hood a little bit around how these people are innovating on the underlying finance product and some of the legal registrations and security charges that go around that. So Jess, can you lift the hood a little bit and explain, some of the innovations at at Hope Housing, about that you've done on the lending and security side of things?
Sure. So when we co-invest with a homeowner, one of the really important features is obviously the borrowing that gets set at the homeowner level. And because we're working with essential workers, even though typically many of them wouldn't fall into what would be considered an income level to be, able to achieve affordable rental or affordable schemes under government schemes, they're still really looking for affordable solutions for themselves. Everyone wants to keep their mortgage as low as possible. And we know in situations where you're not in a co-investment arrangement, you're often really pushing yourself and your borrowing power to maybe 40 to 50% of your gross household income. So when we sat down with Police Bank to design the product, we wanted to make sure that the mortgage settings under the arrangement were very affordable for the homeowner. So what that meant was setting the servicing of the mortgage to no more than 30% of the gross household income, which is a typical affordability metric across many different agencies and government levels. What that actually does is it compresses the amount that the homeowner actually borrows under the arrangement. So a typical example would you might be able to go to the bank and get sort of 5 times income. In our situation, that would take you from say a 600,000 lend down to say 450 in a Hope arrangement, which can seem kind of counterintuitive, this idea that under a Hope model you actually borrow less. But what that means is once you factor in your deposit, that borrowing amount and the co-investment on top of that, you're still pushing into a place where you actually have buying power to get something decent close to where you work. So we have a really affordable mortgage setting inside of that arrangement, coupled with an equity investment. But then one of the other things that was really critical when we set up the arrangement was how we thought about the investor protections on our equity share in the house. So we are not a debt instrument at all. We are not a debt exposure. In fact, we have no credit risk in the arrangement. We are pure equity in the capital structure. And typically a bank would register a first mortgage, and they do in our arrangement as well. But that first mortgage is actually realistically secured against the equity share that the homeowner has in the property. And so the bank's recourse is limited to that equity share. They have no recourse to Hope's equity share, which is a very important investor protection and creates fairness across the whole structure. And that's something I think everyone on this panel will have been striving to achieve, because you have two key stakeholders. You have a homeowner and you have an investor, and you're always trying to balance both of those objectives. But to do that, to get banks to agree to do that wasn't easy, and you have to have a bank that's willing to go on the journey, that's willing to acknowledge that this isn't typically how their risk team sort of thought about their risk exposure to an asset. And so it took a lot of conversations at the bank, a very motivated CEO and chair, and also discussions with APRA and the mortgage insurers to really make sure that across that structure it was still within the responsible lending guidelines, the risk parameters were covered adequately, and that enabled us to actually get the product off the ground. So it certainly isn't without its challenges, but if you have a team of people that are really willing to think differently and not just say this hasn't been done before, no, then you can actually achieve real structural change.
Thank you, Imogen. Tell us a little bit at Own Home how you're innovating around the lending and the risk.
Yeah, you're going to hear different flavours of models here, and I think you're going to hear like rainbow and chocolate chip and some like sexy berry. We're like straight vanilla. We're the most boring product you have ever come across in terms of a lending product, because we are just a second mortgage. And the real innovation in that is that we're really straightforward. So in terms of a bank partnering us, we only work because we're a partnered product. So we're a second-rated mortgage. We are registered behind the first mortgage. The benefit for a lender that's partners with us is that they only have exposure up to 80%. So for them, the risk is really, really low. And that means that they can offer those really low 80% rates on that portion of the home loan. And the benefit for the client, if they're using a deposit boost loan, is that they can switch out that 80% provider. So ordinarily, if you were to buy a property with lender's mortgage insurance, if you switch your lender, you are liable for lender's mortgage insurance again. But with us, if you switch your 80% out, you are not liable for lender's mortgage insurance. And so that's really how we fit into existing bank policy. Just like any other liability that somebody was to have if they would apply for a loan, they would factor into the repayments. It's the exact same with us. So we factor in the repayments for the 80% to own home, they factor in the 20% to their repayments, and so your overall borrowing capacity is slightly lower. We're certainly not the product to use if you want to like supercharge your borrowing capacity. But sorry, I'm just dropping stuff. But we're definitely the product if you have an incredible earning potential, but you do not have those savings up front. So that's kind of from like a legal and finance side. The part though that I'm most excited to talk about always, and the part that our clients are most excited, they actually don't care when they get a home loan with us. That's not what they're excited to talk about. The moment they're approved, they never want to talk about the fact that they have a home loan. It's the most boring topic in the world. But what they are really excited to talk about is the home buying experience, because that is so terrible. And what we always say to clients, and what we know to be true, is you make money on property when you purchase, not when you sell. And so it's really important to be careful when clients are buying property that they're buying the best property at the right price. And so we have done a ton of work to make sure that when we're buying properties on behalf of clients with our like free buyer's agent service, we've done all of the lead work to make sure that it's a really good purchase. We know exactly the value of that property before we buy it. And to put this into kind of context, we have a client who bought just around the corner in Greensborough. They had a quite complicated family set up. There were 7 of them. They had a grandparent in the mix. They needed them to be able to buy their home. We had found a property for them and valued it at $950. The bank also valued it at $950. We negotiated for $921 for them. And so the day that they moved in, they had $29,000 of equity, which was more than their deposit size. And so you can genuinely transform lives by the way you help people purchase property, and that is a free and included part of our service, which we love.
I love it. Thank you, Imogen. Michael, now you're innovating around the equity to innovate around the debt. Explain to us what you're doing.
Yes, so we've taken the concept of a guarantor home loan and evolved that into a diversified investment product. And so early on, we were mulling over the Hayne Royal Commission, which cracked down on guarantor home loans because of the financial risk it placed on guarantors without any financial reward. And so back then, even your mate could act as your guarantor, but now that's been whittled down to essentially your parents. But it's disproportionately impacted the 40% of Australians who don't have the luxury of relying on their parents to act as guarantors or provide them a gift. And so that's when we decided to innovate on the underlying financial product, but on 2 conditions. One being, it had to be safe or low risk enough for us to have our parents participate in it. And 2, it needed to provide an attractive return. We couldn't just rely on charitable intentions. And so little did I know back then that creating something new in the banking and investments industry is not for the faint-hearted, largely because of the idiosyncratic risks around a highly regulated environment, selling to enterprises. The enterprises are risk-averse because they're lenders, so you need a fully baked product. Okay, that needs a massive upfront investment, and good luck getting an upfront investment that's sizable from a VC without a product or any traction. So it felt like a bit of a stitch up early on, and our solution was, wake up every morning and be like, God, please help me, and then find the right people to work with, because that's made all the difference. We've had very supportive investors from day one, an incredible team that we've been able to build up, and they came for the what, they stayed for the why, and it's been quite a roller coaster. So where we ended up with our solution is a coordination across 3 stakeholder groups, being the established homeowners who are investors, the lenders, and then the aspiring homeowners who are their customer. And for the established homeowner, they're able to generate a return on inaccessible equity without any capital outlay That's a new financial instrument. There's over 7 trillion in residential real estate equity after mortgages in Australia, by far the largest asset class, and largely dormant because people can't even access it to invest. But now they can generate a return of 3.5% to 4% per annum without a capital outlay. So we've essentially figured out how to monetize that. For the lenders who partner with us, they're able to offer a reduced interest rate home loan with less risk and improved margin, which sounds like a bit of a paradox, but it's because of the way our solution impacts their balance sheet and their product. And so, for example, with one lender we're preparing to pilot with, they will have the best interest rate for the below 10% deposit segment and equally best for the below 20% deposit segment, without compromising on risk, without compromising on margin, and so that's sustainable pricing power. And then, of course, for the aspiring homeowners, they're able to get a property with as low as a 5% deposit. They save on LMI. They get a interest rate that's 30 to 100 basis points lower. And so that's the real value, and we barely have an interaction with them. We're not on their title. We don't take equity share. We don't take equity upside. Our relationship is very much with the lender.
Thank you, Michael. I love they came for the what, but they stayed for the why. And I also love that you said we created a product that we will put our own parents into. Linda, so you're innovating around the way people own property on title, the way they borrow the money there, and also the way people create wealth and get on the property ladder, and Bank of Mum and Dad. There's a whole lot going on with property. Tell us a little bit more about the detail of what you're doing.
Sure. So our whole solution is predicated on tenants in common, on title registration. And I think a lot of people misunderstand the difference between tenants in common and joint tenants. And I don't know, I would actually, not that this is financial advice, but it's funny coming across people that are married that are actually bought tenants in common because people do split up. But essentially the difference is that tenants in common allows on-title fractional ownership of a property in uneven proportions, whereas joint tenants, it has to be equal because you jointly own it with the other person. So for example, if you had friends that wanted to come together and buy a house, you can be sort of 40-40-20, like whatever mix you want. And also there's no survivorship. So actually your sort of fraction is forever yours. So if something, God forbid, happens to you and you pass, actually your fraction can be bequeathed in a will to someone else, like to your kids, or you can sell it to the extent you can sell it to someone. It doesn't pass to the person that you bought the house with because you don't jointly own it. And our solution is also about being on title. So it's not an investment product. You are on title for your fraction. You can live in the property should you wish. We are agnostic as to whether you want to live in the property or actually co-buy the house for investment and go rent it out or Airbnb it. I guess we're just very clear that we don't do property management, we don't matchmake people, we don't do property search, but we essentially do everything else in terms of executing that transaction. And it's really about putting the necessary legals in place to protect that arrangement. We don't lend, we are working with lenders, and we feel that there are a number of ways to be more innovative around co-ownership scenarios, because actually the credit risk is lower. You're sharing costs and pooling resources, but you could argue the liquidity risk is higher, right? So we love tenants in common because we feel like no one's ever digitized it, and it could truly empower a fractional on-title market. So, early days, but we sort of have visions for a fractional loan product where the fraction is the security alongside a fund structure that could bring that to life.
Fantastic. Now, we are pretty much out of time, but I might just finish and ask each panellist really quickly, what's the biggest highlight from the last 12 months? And can you just give us like one little sneak peek at what's coming up for you in the next 12 months?
Biggest highlight is always seeing the faces and expressions of homeowners when they are able to finally buy their dream home. And then on the investor side, being able to deliver returns in market that are twice what the Sydney CoreLogic benchmark does has been incredibly satisfying, and I think demonstrates to investors coming in that this has real potential to deliver compelling returns.
Okay, Imogen.
I think everyone's going to say customers, so I'm going to say the team. I'm super proud of the team that we're building our own home. It is so ambitious, it's so customer focused, and it's super hungry to make a real dent in this challenge, and I'm just incredibly proud of my colleagues. Love them to death. And then the thing I'm most excited about this year, well, like honestly so much, but we currently have 15% of the broker market access to it. We know that 75% of first home buyers buy their first property with the support of a broker on the finance side, and this year we have really clear eye of sight to nearly 80% of the broker market. So I think scaling is the thing that I'm most excited about, because that with scale comes impact. So that.
Michael.
Excited that we were able to get 40 mil in equity commitments without spending $1 on customer acquisition. Really a testament to sort of the latent demand for the investment product. And then we're currently working with 2 lenders to get a home loan pilot out to support about 250 mil worth of home loans. So I'm eager to see that in market in the next few months.
And Linda.
Thanks. Well, like the last 12 months, Co-opity was a piece of paper. So I'm very, very happy that we have built, launched, have a team of 7, completely self-funded, and we have some, key integrations we're working through. We have a property firm that wants to integrate as well, so we sort of feel between property firm that wants to sell more houses, lender that wants to write more loans. We will have a fully integrated co-ownership solution, including home financing, and we sort of feel like not only co-ownership, you can get on the ladder faster and more cost effectively. It actually accelerates more, ownership for more people from existing supply, and there is a supply issue. So very excited about the next one.
Phenomenal. Well, our time is up, but you can see this is a fintech topic, it's a prop tech topic, it's a legal tech topic. I mean, it is, we're all in this together as well. Right? So I think they'd all love you to come and continue this conversation, but for now, please thank the panel.
Thanks, Jennifer.
Thank you.